5 essentials you need to know about every stock you buy. Taking your money and putting it in various investment vehicles can appear to be a simple thing to do. The reality is, however, that if you want to be a great investor, it may be a very challenging endeavor. Every year, a significant number of retail investors, which are investors who are not professionals, suffer financial losses. There could be several reasons for this, but there is one that every investor who has a career that is not related to the investment market is aware of. They do not have the time to research a large number of stocks, and they do not have a research team to assist them in completing such a monumental task. Hello everyone and welcome to another video on our channel. In today's video, we're going to discuss the 5 essentials that you need to know about every stock you buy. So stay tuned to find out. Now let's start our video. What stocks do? If a potential investor does not fully understand how a company generates profit, they should not invest in the shares. Which products do they make? What exactly do they provide for customers? In which regions do they have a presence? Can you tell me their best-selling item and how it's doing in the market? Is their company widely regarded as the best in its industry? Consider this to be the first meeting. In most cases, you wouldn't ask someone out on a date if you didn't know anything about them. You're just asking for problems if you do that. You may easily get this data online. Visit the company's website using the search engine of your choice to learn more. Then inform a close relative about your planned investment. You have demonstrated sufficient knowledge if you have satisfactory responses to their queries. Price to earnings, PE ratio. Imagine you needed an investor. 2 financial advisors are interviewed. One has made many people rich. Your friends have made much money with this financial advisor, so you see no reason not to. They say they'll retain 40 cents of every dollar you make, leaving you 60 cents. The other advisor is new. They lack experience and a track record of achievement while being promising. This counsel is inexpensive, therefore invest with them. They want 20 cents of every dollar you make. What if they don't make as much as the first advisor? This example explains the price to earnings or PE ratio. These ratios compare a company's share price to per share earnings. Analysts and investors might compare the firm to others to estimate its value. A PE ratio of 20 suggests investors are prepared to pay $20 for every $1 in earnings. If the firm is growing quickly, they may not be pricey. Comparing the current market price to the past 4 quarters' profits gives the PE. Compare this figure to similar firms. Your company's high PE ratio should be justified. Lower PE, yet rapid growth is a good investment. Beta. Beta isn't hard to comprehend. It gauges stock volatility over the previous 5 years. It compares a company's stock to the market's systemic risk. Yahoo or Google stock research pages frequently list the beta value next to the PE ratio. S&P 500 is mental stability. Your company's beta is larger if its value changes more than the index over 5 years. High beta means high risk, whereas low beta means low risk. How well does beta predict basic risk factors? High beta stocks can make you a lot of money, but they can also take it. A lower beta suggests a stock reacts less to S&P 500 fluctuations. This defensive stock keeps your money secure. You won't make as much, but you don't have to watch it daily. If you're liking this video so far, please consider subscribing and liking the video. Now let's continue. Dividend. Invest in dividends if you don't have time to check the market daily. Dividends are like savings account interest. They're paid regardless of stock price. Dividends are profit distributions to shareholders. The board of directors decides the dividend amount, usually paid in cash but sometimes in stock. Dividends provide a steady income for many investors. Companies usually release them quarterly. Traditional investors like dividend-paying corporations. They can reassure investors during economic turmoil. Large corporations with stable profitability offer the best dividends. Oil and gas, banking, and financials, basic commodities, healthcare, pharmaceuticals, and utilities are dividend-paying industries. High-quality equities might provide 6% dividends or more. Startups may not be profitable enough to pay dividends. Check the company's dividend rate before buying stock. Invest in dividend-paying equities to park money in the market. The chart. Stock charts vary. Fundamental and technical analysts employ line, bar, and candlestick charts. Reading charts may be difficult. It isn't very easy. Reading them takes time. How does this affect regular investors? You don't have to neglect this step. Basic chart reading is easy. A solid investment chart goes from the bottom left to the upper right. If the chart goes down, don't investigate why. There are many stocks to select from. Put this stock on your watch list if you like it. Many individuals invest in companies with terrifying charts, but you don't have time and resources. Well, that's all for today's video. Tell us in the comment section how this video was. I hope that you found this video interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable facts and stories. And until then, stay tuned.